A gold toilet and an AI spending frenzy. The strange intersection of art and high-risk finance, a gold toilet and an AI spending frenzy. The strange intersection of art and high-risk finance, it seems almost fitting that amidst the trillion-dollar ambitions fueling the artificial intelligence, AI, boom, we find ourselves contemplating a solid gold toilet. But this isn't just a whimsical art piece heading to auction at Sotheby's. It serves as an unsettlingly apt metaphor for the risks swirling around AI investment. Like many companies scrambling to keep pace with the rapid advancements in AI, QTS Data Centers is pouring billions of dollars into expanding its network of cutting-edge computing facilities. However, instead of relying solely on traditional funding methods, QTS's parent company, Blackstone, is turning to increasingly exotic financial instruments, namely complex debt arrangements, to keep pace. Blackstone is close to closing a $3.46 billion commercial mortgage-backed securities, CMBS, offering to refinance debt held by QTS. This would be the largest CMBS deal of its type this year in an already rapidly accelerating market. While this financing strategy reflects a growing trend among AI infrastructure companies, it's raising eyebrows due to the sheer scale and complexity of these arrangements. To illustrate, think about $10 million worth of physical gold being poured into toilets, as Maurizio Cattelan, the artist behind the infamous duct-taped banana, did. That's essentially what we're seeing with Blackstone's CMBS offering. The question is, while shiny on the surface, how much real value does this gilded debt offer? A surge in debt amidst growing uncertainty, the need for vast capital injections isn't unique to QTS. A McKinsey report predicts that a staggering $7 trillion will be required by 2030 just to meet projected data center investment needs for AI. Major tech companies like Google, Meta, Microsoft, and Amazon have collectively poured $112 billion into capital expenditures in the last 3 months alone. This frenzied spending is fueling investor anxieties. Meta's stock plummeted after revealing its aggressive capital expenditure plans last week, while broader tech stocks have taken a hit due to concerns about over-evaluation. The growing reliance on debt financing within this AI infrastructure race is creating a financial dance of risk and uncertainty. Companies like QTS are increasingly turning to instruments like corporate debt, securitization markets, like the CMBS offering, private financing, and off-balance sheet vehicles to access the vast sums needed for their projects. This shift towards more complex and opaque financing structures echoes warnings from analysts about a potential repeat of the 2008 financial crisis. The parallels are stark. Excessive reliance on debt fueled by speculative bubbles can create a systemic risk that threatens broader financial stability if those investments don't pan out as anticipated. The murky waters of off-balance sheet debt. One particularly unsettling trend is the use of off-balance sheet financing, where debts are structured to appear smaller or non-existent on a company's books. This practice can mask the true level of risk a company faces and make it harder for investors to assess their financial health. Off-balance sheet arrangements allow companies to boost their seemingly available cash flow while simultaneously obscuring the extent to which they're leveraged, a recipe for potential trouble down the line. The need for caution. While AI holds immense promise, this gold-plated toilet of finance serves as a chilling reminder. Unbridled speculative fervor and an overabundance of borrowed money can create perilous situations for investors and the broader economy alike. It's crucial that regulators scrutinize these opaque financial instruments and ensure that the pursuit of short-term gains doesn't jeopardize long-term stability in this rapidly evolving technological landscape. The true value, or perhaps more accurately, the potential danger, of all this gold won't be fully understood for quite some time.